Good afternoon, traders and investors. Will back here with another one, coming to you with a Monday market video. Hope everybody had a beautiful weekend. So in today's markets, guys, everything pretty much ending up in the red after we had two negative catalysts coming in the past 24 hours. Number one, we had Jerome Powell having a 60 minutes interview yesterday on Sunday night, where he reiterated the fact that most likely there will not be any rate cuts in March. So we'll take a look at that. And number two, we had a services inflation report come in earlier this morning. The markets did not digest very favorably. And that services report showed that inflation had a slight uptick in services. And as we've been following on the channel, guys, it's really not the goods part of the economy that has sticky inflation. It really is services. And that was reiterated in this morning's report. So we're going to take a look at that as well. Additionally, I do have three earnings reports that we are going to cover today ever so briefly. We're going to do McDonald's, we're going to do Palantir, and lastly, we are going to do ON Semiconductor, another one of our semiconductor plays. Followed by that, we're going to do our major technical analysis on our indexes, followed by your major tech names as well. And lastly, take a look at my portfolio and see which positions we have running for the week. So without further ado, guys, let's get right into today's video. So SPY down 0.36% on the day, QQQ down 0.13%. But when we take a look at the heat map here, guys, you will see that it was a very ugly market overall after those two negative elements came in, Jerome Powell and your services report this morning. So the really bottom half of the market here not having a good time. It's really the case of a divided market right now, guys. You really have companies that are performing well, which are the companies that have a lot of cash on their balance sheets and not a lot of long-term debt. They really don't mind about interest rates being higher for longer because they have a lot of cash, they have pricing power, and they don't have a lot of debt. But then you have a lot of other stocks which are really beholden to the way that inflation and interest rates are proceeding here into the near-term future. So we really have a divided market here whereby your inflation and interest rate sensitive stocks are really getting hurt to the downside with every single piece of news that comes out that hints that rates could be higher for longer. But then again, you do have a lot of tech companies, especially semiconductors, with a lot of profits, a lot of cash on their balance sheets, and most of big tech, which is in the same position of having a lot of cash on their balance sheets and having low long-term debts, which are providing a bit of a safe haven trade for the markets right now. So you really have a divided market currently. Personally, I do believe that the better risk to reward is making bets on those interest rate sensitive stocks, as when interest rates come down, they will most likely be the ones that will stand to gain the most from that. So on the one-day relative, you'll see that healthcare and technology etched out some ever so slight gains here, mostly bolstered by Eli Lilly on the healthcare side. And in terms of your big tech, well, obviously semiconductors were leading the way once again, and fairly mixed across the board. Microsoft pulling back after its earnings gains, Meta as well, Amazon as well, a bit to the downside after its earnings gain. But for the most part, big tech holding up fairly properly on the day. So before we get into our technicals, guys, let's get into exactly those two pieces of news that affected the markets. So number one, stocks sink after Fed Chair Powell pleads patience on rate cuts. So here's a snapshot from his 60 Minutes interview yesterday. We'll go over this very, very briefly. U.S. stocks fell Monday after Fed Reserve Chair Jerome Powell said Sunday that central bank is not ready to cut interest rates yet. So reiterating once again after last Wednesday's meeting that March is most likely off the table. We want to see more evidence that inflation is moving sustainably down to 2%. Our confidence is rising. We just want some more confidence before we take that very important step of beginning to cut interest rates, because obviously that'll be the beginning of the entire cycle. Powell dashed investors' hopes for a rate cut in March at the Fed post-meeting press conference in January, which is last Wednesday pretty much, with that optimism further waning after a shockingly strong January jobs report. We're talking about the non-farm payrolls jobs report that we covered last Friday on the channel. Powell on Sunday doubled down on the unlikelihood of a cut next month. However, there was a silver lining in this, guys. He said that in terms of the data they're expecting, that they would most likely be looking at data. The data doesn't need to have to be as good as it has been in the past 6 months. It just needs to be good. So signs that they are very confident inflation being able to come down. They may not need to see as rapid of a pace of inflation coming down as precedingly, but any pace down will be most likely a good step in the right direction for the Fed being able to cut rates later on in the year, most likely May or June at this point, right? So traders now see a 17% expectation that the Fed will cut rates in March compared to 46% a week ago. So expectations coming widely down for a March rate cut. For June, financial markets are pricing in a 93% chance that the central bank will pare back rates. So now second half of the year is pretty much guaranteed at this point. The Fed will only drop interest rates in two scenarios, guys. Number one, just to normalize what they've been doing, right? So now that rates are high, if the economy keeps doing good, if jobs keep doing good as well, they'll just taper back interest rates really to normalize where things have been in the past. But number two, he can cut interest rates if ever the economy really starts falling off a cliff. If unemployment starts rising, then they obviously have to drop rates quicker. The second scenario in which the economy falls apart and the job market falls apart is obviously going to be bad because that would be synonymous with a recession. So we really want option number one here, where inflation continues to trend slightly down ever so slowly, and where we also have a strong jobs market and a strong economy on the backdrop here. And that is predicted to be the most likely scenario here. So number two, what came out this morning, guys, is your ISM services PMI. So inflation data coming out of your services index for the US jumped to 53.4 in January 2024 from a 50.5 read in December. So you can see the read here upticking very high in the month of January, as opposed to December. It had been on a nice decline trend here, but now we have a significant uptick in January. Now in January, producers and service providers do tend to put in their annual price increases over the month of July, which is why you also had a significant uptick last year in 2023 here in January and February, and then they kind of tapered off. So it could just be a little bit of cyclicality in terms of those new price increases coming in for the year. The reading pointed to the strongest growth in the services sector in 4 months, as we saw in the chart, led by new orders, employment, and supplier deliveries. Meanwhile, backlogs of orders rebounded, while business activity growth steadied and price pressures intensified. So higher price pressures in terms of your services. That's just their annual increase in services rates. You can think of anything about insurance companies or stuff like that, right? Where they usually increase their rates at the beginning of a new year. Finally, service firms are optimistic about the economy due to the potential impact of interest rate cuts. However, they are cautious due to inflation, associated cost pressures, and ongoing geopolitical conflicts. So services inflation still remaining fairly sticky. It is on a downtrend on a year-over-year basis, but it is proving to be more sticky, at least more sticky than the goods component of inflation. So we'll have to keep a very close eye on services. In my opinion, goods inflation is pretty much done for. We really need to be focusing on your services inflation here. So those are the two things that dropped the markets today. And you can really see the impact that they had on yields. Jerome Powell's comments and that services inflation data really pushing yields up, just once again playing into the story that as long as inflation remains persistent and as long as as long as the economy is still good, the Fed just may need to keep rates higher for longer. But guys, we're really coming to the end of the cycle here. There's only so much negative news that can continue to bring these interest rates higher on a 20-year and a 10-year yield basis, right? So we're really nearing the end of a cycle. I'm fairly bullish on the downturn continuity of your yields here, meaning that we're in the bottoming process of bonds, obviously inverse correlation between the two. So we're going to have to keep a very close eye, but I do believe, guys, that these negative headlines will not persist. The only thing that can really derail these markets if inflation starts moving higher. That is the only thing. If the inflation starts moving higher, guys, the entire narrative falls apart. So we'll keep a close eye on that. But as of now, guys, no signs of runaway inflation just yet. So before we get into more technical analysis here, let's go over a few earnings, and I will do these quicker than previous videos, I promise. So number one is going to be Palantir. So Palantir, right? Palantir had a beautiful earnings call here. I'm not too sure why though, but they're up about 20% in the after hours, but I'm not too sure why, because they didn't really provide improved guidance by that much, and they didn't really beat expectations by that much either. Everything kind of came in line, but I guess the market was just really hyped up in anticipation of these earnings. They did have, leading into this move today, they did have about a 14.5% expected move to the up or to the downside. So it's nice to see Palantir deliver on their earnings. But not only that, they did reiterate their guidance that they had already previously forecast for Q1 of 2024 and 2024 as a whole. So at least things looking bullish for the company, but up nicely, almost 20% in the after hours here. Earnings, EPS beat by about 6%, and revenue beat here by about just under 1%, excuse me. The one drawback about Palantir, guys, is the company is relatively expensive. Now, I know that this is now their 5th quarter of profitability, but if you take a look, guys, at the EPS, right, you really have to believe in this company for the long-term growth because their EPS is currently only 0.25. So if we take in terms of their current price, let's call it about 1975 after the last traded price, right? 1975 divided by a quarter of EPS, their PE ratio on a trailing basis, 2023, is about a 75. If you take 2024, it's not much better either, right? 19.75 divided by 0.29 is about 68. Price to earnings ratio. So the company, the company is fairly expensive in terms of valuation. You really need to believe in the growth story over the next 5 to 10 years with AI implementation and large language model implementation. Palantir is really at the top of the game right now in terms of their AI facilities that they run for commercial and government services, but the company is fairly expensive, right? They are pricing in a lot of growth, so it'll be up to Palantir to deliver that growth. But so far, so good. The quarter was fairly decent, and the company does not have a lot of debt either. As a matter of fact, they don't have any debt, and they are now posting positive free cash flow. So let's take a look at some of the earnings highlights here from the slides. So you'll see that they did have very nice 70% year-over-year US commercial revenue growth, but their commercial revenue is not that high. That's why it looks like a big number, but in terms of the hundreds of millions of dollars that they bring in, it's really not that much in terms of versus their market cap, right? So this is another problem that I have with Palantir. Their market cap is at $36 billion, and for the year, they only brought in about $2.2 billion. So they're trading roughly at an 18 price to sales ratio, a 75 trailing 12-month PE ratio. That's why I say the company is a little bit expensive. Now, I do play this because there's a lot of retail interest in the stock, but I would be lying to you if I said that the company looked cheap on a fundamental basis. Right, so here we go. So we did have a 55% year-over-year U.S. commercial customer count as well, and 32% year-over-year customer U.S. commercial remaining deal value. Very, very good here. Increase in U.S. Commercial deals closed, which is very good as well. 13x in terms of the 3-year U.S. commercial customer count growth. Well, that's just because before they almost had no commercial customers whatsoever, and that was a big thing that a lot of people had with Palantir stock, is they were saying that it was only going to be a play. They only had contracts with governments. Well, now Palantir for the past couple of quarters has been showing that they can expand their revenue streams and are now looking into providing services for a lot more commercial clients than before, really diversifying away from that government the government contracts that they did have. Now you can see here that they are now finally reporting for the 5th quarter in a row a GAAP net positive income. So before, the company was losing a lot of money, but now you can see $93.4 million in GAAP net income for the most recent quarter. Very, very decent. GAAP operating income as well is up as well for now the 4th quarter in a row. Very, very good. We achieved GAAP operating profitability for the 4th consecutive quarter. Means they're eligible now for S&P inclusion. Very, very decent right here as well. Commercial revenue growth, here's your number, right? So from 215 million all the way up to 284 million in the quarter Q4 2023, very decent. Right. And here's your US commercial revenue growth as a whole. So just for the United States, up a whopping 70%, but only $131 million for the quarter, guys. Not that much money as a whole, right? Government revenue growth is up as well, 11%, very, very healthily, up to $324 million for the quarter. Very decent, still their largest line of business. The US represented a 6% gain off of that. So all metrics up. Total revenue growth, very, very decent, 20% year over year and 9% quarter over quarter, driven by the continued acceleration of our US commercial business. So very good revenue growth and expansion by the company here. Right, average trailing 12-month revenue per top 20 customers also grew by 11%. So it just goes to show that they're able to retain a lot of their customers, which is good for the company. And billings did have a net uptick here in 56%. So charging every single one of those clients more money and offering them more services. As a whole, the company is growing very, very nicely. Adjusted gross margins are now up to 84%, which is very, very decent as well. A few other slides that I did want to show you guys is the US commercial customer count. So this is now their growing customer count here over the past year, 55% year over year, up to 221 US commercial customers. This is very, very good, but need to see that continued expansion here. I'll show you in terms of their, excuse me, in terms of their guidance for the next couple of years. They do have decent EPS expansion, nothing fancy. It is growing at about 20% per year, but still only in the pennies range, right? But the revenue growth is quite substantial for Palantir. So they just put in their $2.2 billion a year. And next year, you'll see that they will be expanding roughly about 20%, over the next couple of years, between 50-20% revenue growth, which is very, very good for the company. But I'd like to see an acceleration on that. I'd really like to see them continuously beat expectations to really bring their revenue and EPS a lot higher, a lot quicker than people expected, so it can really grow into its valuation a lot more quickly. Now, during 2023, we closed 103 deals of at least $1 million. So it just goes to show you that most of the deals that they are making are fairly high ticket deals, 37 of which were at least $5 million and 21 of which were at least $10 million. So really going for those high ticket sales there. Very, very good. We ended Q4 2023 with $3.7 billion in cash equivalents, and U.S. Treasury securities, and no debt. Now, I do think that this is a main reason why the stock is getting so much lift. It's just basically because their balance sheet is very, very solid, guys. Now they're profitable, and they became profitable without running a ton of debt on the balance sheet in the process, which is rare for a growth company, I will admit that, but very, very nice to see that they have now positive free cash flow and still no debt on their balance sheet with a high amount of cash and cash equivalents. So they'll be able to service everything, even if they do choose to do high capital expenditures. Well, at least now they do have some decent money on the sidelines to be able to do that. Now, here's their guidance for the first quarter, right? So revenue of between 600, let's call it 615 million, which is in line with Wall Street expectations. I didn't pull up the article, but it's pretty much right here, right? Wall Street was expecting 617 million during the fourth quarter and 2.66 billion in revenue for the full year. Now compare that with exactly what they're saying, right? 2.66 billion for the full year forecast as well. And here's the revenue for the first quarter. So everything in line with what Wall Street expected, which is why I'm so surprised that the stock gained as much, but very decent quarter for Palantir as a whole, very decent year for Palantir as a whole. And now most likely will be applying for S&P inclusion. And they will continuously be churning out free cash flow. Here you see the guidance for the year, free cash flow between 800 million to about $1 billion. So very, very decent, guys, right? Very, very decent growth in terms of the company, growing total revenue by roughly about 15-20% a year, growing EPS, growing free cash flow, and have a high amount of cash on the balance sheet, no debt, which is why the stock has been performing fairly decently. But as I said, guys, in terms of the fundamentals, fairly overvalued. You're really buying into this company for the next 5 to 10 years of its growth, because a lot of its growth is currently priced into the share price right now. Now, let's move on to our second company that we're going to cover, guys. So we're going to cover McDonald's. So McDonald's performing today 3.73% to the downside. Apologies, you can't see it. So 3.73% to the downside for McDonald's. So very unfortunate drop for them. But guys, leading into this, the company was at all-time highs. McDonald's really didn't have anything, substantially negative on their quarter, except for the fact that they were plagued a bit by the boycotts in terms of the Middle Eastern conflict right now between Israel and Palestine. So they did comment on that, and Starbucks commented on it as well. So earnings, you can see earnings up here by about 4.37% on the EPS, fairly good, but down ever so slightly on revenue. Now, McDonald's is a company, guys, that needs no introduction, right? They do have very decent profit margins, usually coming in over 30%. And you can see here for the quarter, I didn't put it on the chart. It's not on the chart right now, but we'll get through that when we go through their balance sheet in a moment. But the net margins, guys, are about 35% for the quarter and for the year as well, which is very, very good. So continuous revenue expansion, continuous EPS expansion as well, but obviously a very mature company, right? So EPS will be expanding at pretty much under 10% a year for the next 4 years. And revenue as well will really only be expanding, roughly about 5-6% for the next couple of years. So McDonald's really not in a position where it's growing much currently. And the stock price is continuously, trading at all-time highs right now. Not a buy for me personally. I do believe that there are better companies in terms of value that you can go pick instead of McDonald's. But McDonald's definitely a sure bet for anybody's portfolio. The company is definitely not going anywhere. So let's take a look at some of the highlights here, right? McDonald's revenue misses estimates as Middle East conflicts weighs on quarterly sales. The fast food titan beat earnings estimates, but missed on revenue as international markets lagged. The company said conflicts in the Middle East hit its sales in in the region. So let's take a look at exactly what they said for that. Net sales rose 8% to 6.41 billion. That's good. The chain's global same-store sales grew at 3.4% in the quarter. Very low, guys. Similar to Starbucks, right? You want to see this between, anywhere between 7 to 10%. If you really want to have a growth story here, 3 to 5% is really on the low end, falling short of the estimates of 4.7. So big miss in terms of same-store sales as its Middle Eastern sales struggled. The international development license market segment saw its same, this is just fancy for pretty much everything in relation to your Middle Eastern and African markets. The international developmental licensed markets segment saw its same-store sales increase just 0.7%. McDonald's said the division's sales lagged as a result of the Israel-Hamas war. McDonald's has seen its Middle Eastern sales falter from boycotts after its Israeli licensee offered discounts for soldiers. The company has also had to shutter some locations temporarily to ensure employees' safeties from protests. Boycotts also dented Starbucks' quarterly sales, which we saw last week. The company is monitoring the evolving situation, which it expects to continue to have a negative impact on system-wide sales and revenue as long as the war continues. So a little bit of a temporary plague for McDonald's here. Domestic same-store sales, however, rose 4.3%, about in line with expectations. So that's pretty much your US, North American markets, helped by menu price hikes. But the company is quickly running out of pricing power. They had a little bit of a slowdown here in France as consumers refused to continue to pay for higher prices, and same-store sales lagged a lot in France. So France and a few of their European markets, consumers are now pivoting away from McDonald's because McDonald's is not growing revenue by the fact that it's growing foot traffic and volume, as we saw by same-store sales. It's only raising its revenue right now by doing menu price hikes. And unfortunately, McDonald's is currently running out of pricing power as consumers just don't want to pay the higher prices anymore. In the third quarter, McDonald's said its US traffic fell as low-income consumers pulled back their spending. It was the first sign that diners were beginning to shy away from the chain's higher prices. So bit of a pricing power issue for McDonald's currently. Now let's take a look, guys, at their financial statements and see if anything has massively changed. It really hasn't. Global comparable sales have grown 9% for the year and over 30% since 2019. Very good. System-wide sales to loyalty members were over 20 billion for the full year and over 6 billion for the quarter across 50 loyalty markets, with full year growth of more than 45% over the prior year. So very good loyalty program through their app, which does provide you points whenever you go to McDonald's. Same thing for Starbucks. Starbucks was also saying that one of the highlights of their earnings was a strong loyalty program. Now, let's go down here, guys. Right, global comparable sales increased at 9%. US increased 8.7%. International operated market segments increased 9.2%. But here is your line of business that didn't perform too well in Q4, but had a very good start to the year otherwise. This is as a result of the whole Israel-Hamas war right now. International developmental licensed markets segment increased 9.4%. Consolidated operating income increased 24%. So they did have increased profitability this year, guys, and that's largely a result of their increased prices. Now let's take a look here at their net income. So you can see that net income for the year, I don't know why it erased my highlighter right here. So let's do the math again. So their net income, 23.9 divided by 24.74, which is their total, I have to take the 6,000 number. So 2039 divided by your 6,406 is going to be net margins of roughly 32%. And you can see that in terms of their previous lines, let me move myself over again. That's better than 2022. It's in line with 2021, right? So anytime McDonald's can put in over 30% margins for a year, it's good. 2018, 28%, 19, 28%, 2020 COVID, 24%, then 21 up to 32, and then last year 2022 back to 26. Well, now you guys can see that they're back up to that 30% range, 32% net margins for the year. So very, very, very good, guys, in terms of for the quarter. That was for the quarter. In terms of the year, it's roughly the same. So we got the 8,468 divided by your 25,493, which is roughly about 33%. So even better. So quarter and the year, pretty much 33% range. Very, very good there. And they did have a very decent increase in cash and cash equivalents from the year. You can see that in terms of 2022, right? So end of 2022, they had only about 2.5 billion in cash and cash equivalents. And now at the end of this year, they've increased that by about $2 billion to about $4.5 billion, increasing their free cash flow as well. So free cash flow for the year was about $7 billion. So very nice increases. McDonald's is still not losing money. It's just that they're not growing as fast as they once were, obviously, guys, but still a very resilient play. I personally like McDonald's, guys. If we get back anywhere between the 260 to 250 range, that is when I would be tempted to play a little bit of McDonald's. But right now, trading a little bit too rich for me. Now, let's move on to our third and last play, which will be ON Semiconductors. So ON Semiconductors, guys, if you remember from last earnings report, we covered this one last earnings when they dropped about 2% after their earnings. And that's because this is a semiconductor play that is very sensitive to what's happening in the EV market. So a large segment of their revenue, I think it's about between 54 and 56%. So let's call it about 55% of all of their revenue comes from their deals with car manufacturers. And now, unfortunately, that EVs have been on a slight downturn ever so recently. A lot of manufacturers, since they lose money making EVs, have pulled back on the production of EVs, which in turn has hurt the demand for semiconductors coming out of ON, which provides a lot of semiconductors for a lot of EV manufacturers. A lot of the largest companies in the world use ON semiconductor chips for their electric vehicles, right? So, but this time, however, increase after earnings of about 9.5%. So you'll see that if I move myself over. So they're up nicely in the after hours, up 9.5%. They did have a double beat here, but not by much. Double beat on earnings here, beat on earnings by about 4%, and beat on revenue, just over $2 billion in revenue for the quarter, up about 1%. ON Semiconductor has never really had a problem in terms of their recent profitability. You can see down here that their profit margins, net profit margins, are in the high 20%, which is very good. But this company is being plagued by their guidance that they gave last quarter, saying that there would be a little bit of a slowdown due to the EV market in 2024. So look at this pull forward demand, 22 and 23, and now a little bit of a downtick in 24 before resuming course. But in 25, 26, 27 should be their best years when the EV market really starts ramping up again. But 2024 should be a fairly slow year for them in terms of EPS expansion. And you see that here in the revenue as well, right? Ever so slight downtick in revenue over the past couple of years. 25, 26, 27 should be reaccelerating. So the company is really just having a bit of a transition year at this point. I do like ON Semiconductors. There's nothing fundamentally wrong with the business in terms of their free cash flow, their debt, their profit margins, or their revenue, or their EPS. It's just that it's going through a little bit of a cyclicality because it's so heavily priced into what's happening with EVs right now. I really like ON Semiconductor, guys. For myself personally, I really like it more between $70 and $60. That's always been my sweet spot for ON Semiconductor. So if we do revisit those prices, that's where I'll most likely be playing a little bit of short puts. I thought about playing short puts in the past 2 weeks, but with earnings so close and with what happened last earnings, I really didn't want to take a chance of being assigned and then the company reiterating even further negative guidance for the upcoming year. But it seems as though they did a great job of pricing everything in last quarter as the company just reiterated the bad guidance that it gave for Q1 and for 2024. So it seems as though the stock has really established its bottoming out process. So here's the headlines here. Okay, ON Semiconductor rises, guidance was good enough, but not great for Tesla and EV makers. So a bit of what we were touching on when we were talking about it. ON Semiconductor's badly beaten up stock was rising after the company issued weaker financial guidance than expected, a counterintuitive gain that holds out some hope for Tesla investors that the worst of the slowdown in growth for demand for electric vehicles is behind EV stocks. That hope, however, was dwindling based on the diverging reactions of ON Semi shares and shares of the EV makers. ON Semiconductor was up 9% today, and Tesla at a certain point today was down over 5%, ending pretty much, in the 3-4% down range. So that's why the article was calling a little bit of diverging reactions here. The results appeared to be in line with expectations, which were scaled back when ON issued disappointing guidance on October 30th. ON is a key supplier of semiconductors to the auto industry for electric vehicles in particular. An October forecast was one of the first signs that demand for growth of EVs was slowing down. So that's exactly what we're touching upon, guys. So here's the CEO. El Khoury had some conservative comments that could be weighing on investor sentiment. While market reports still project 30 or 40% growth for silicon carbide chips in 2024, which is what they make for EVs, OEMs, so original equipment manufacturers, talking about the automakers, latest EV plans indicate a more tapered growth, signaling a SiC, which is just your silicon carbide chips, an SiC market growth in the range of only 20 to 30%. But this is still very good growth, guys. It's just a far cry, of what they were guiding before last October, right? So silicon carbide chips are used more heavily in battery-powered vehicles. So that's pretty much your highlights here for ON Semiconductor. We're going to take a look at exactly how they stand, just to prove to you guys that the company is really not bad as a whole, guys, okay? So their gross margins, very good, 46.7%. Full year 2023 share repurchases of 564 million, because they do generate a decent amount of free cash flow, representing 140% of free cash flow that they generated over the course of the year. So even using some of last year's free cash flow to repurchase some shares. And I'll just show you guys in terms of the financials. Financials are looking very, very decent for this company, despite EPS and revenue being flat for the year. Their financials are really quite solid. I have really nothing bad to say about them. If you take a look here, guys, at your most recent quarterly report here, you'll see that their debt, they only have about 3.7 billion worth of debt. Cash and cash equivalents at the end of the quarter was about 2.7 billion dollars of last quarter. So fairly good, not that much debt in terms of how much cash and cash equivalents and how much free cash flow they do generate. So fairly decently run business here, guys, right? Fairly, nothing bad to say about the company at all. The company brings in between 8 to 9 billion dollars of revenue every single year at this point, and their debt is roughly half of that. So very, very good, debt to sales ratio in terms of that, guys. So here we are also going to put in terms of their net margin. So take a look at their net margin for the year ended. Nothing wrong with the company here as well. This is why I do still like playing this company. So 2183 divided by your 8253, you'll see that the December for the year end here, 2023, 26% net margins, guys. Really nothing bad to say about the company whatsoever. Let me just go down. I do remember highlighting a few more things. So we're going to take a look at their free cash flow as well, just to show that you guys that they are able to generate a decent amount of cash. So take a look at their free cash flow here, guys, right? So in the past couple of quarters, you'll see that they are always generating. This past quarter, they generated about $220 million of free cash flow. In the Q3 quarter, which was their bad guidance quarter, they still generated about $133 million of free cash flow. Very good. So you'll see that, over the past couple of years and whatnot, always maintaining positive free cash flow. Nothing particularly wrong with the company at all. Just really in a cyclical business right now, just tied into EV manufacturers. So that's everything for ON Semiconductor. As I said, I would play this one if we get back into $70, $60 range. Nothing wrong with this company at all. Currently sitting at a very low price to earnings multiple, even though earnings are going to be, roughly flat for the year. They're only trading about a 14 PE, which is relatively low for the semiconductor industry as a whole. So with all of those earnings being covered, guys, let's now get into our technical analysis and see where we stand. So I'm going to do these fairly quickly, guys, because not much has changed whatsoever. Give me a quick second. And let's get right into it. So SPY down here, 0.36% for the day, still looking for your daily higher low, right? So your bears never got complete control of the hourly. After Friday, pretty much, you'll see that today we're trying to potentially set a hourly lower high and lower low. That would be a break of today's low. If you get a break of today's low into tomorrow, potentially in for some daily consolidation here. Keep in mind, mid-February, the seasonality tends to kick in. We tend to have a little bit of a decline in our indexes in terms of what we're seeing on historical data. We also have a new found divergence here. So this is brand new, right? Over the past couple of days, bearish divergence. So could be due for a little bit of a pullback, in which case we're just going to be looking for a higher low, anything above 42.65, looking for a daily higher low for further trend continuation. Still no red flags until we set the daily downtrend here, guys. Still not due for weekly consolidations. Bulls still looking healthy. We're going to keep an eye on our short-term timeframes, but bulls still in control of everything. They control the 12 EMA, still control the 12 EMA largely on your lower timeframes, such as the 4-hour. 12 EMA is very important as well, and still control the series of higher highs and higher lows. So until the bears prove something to us, we are still in uptrends across the board on the weekly and the monthly as well. So just keep an eye, guys. I know the markets are getting slightly overbought at this point, right, in terms of the weekly as well, but no reason that we can't just continue if a lot of these company earnings that we do have this week do remain fairly good. Now, moving on to QQQ, right? QQQ, same concept. So now we do have the daily uptrend underway. So if you do get a pullback here, guys, anything above 416.72, just going to be for a daily higher low for further trend continuation. The bears still not fully gaining that hourly downtrend in market and normal market hours. So that will need a break of today's low, 425.07, for an hourly downtrend, after which we would most likely be in daily consolidation. But as of now, daily uptrend remains safe, right? We do still have control of this 12 EMA on the daily time frame, and weekly trend is just in full expansion mode at this point as well. So it's really up to the short-term bears to prove it to us if they want to set up the daily downtrends, which is going to lead into a few weeks of consolidation here, potentially due to the end of February and maybe even early March in terms of your seasonality. So just keep an eye on that. Now, moving on to XLF. XLF still looking very good, right? Consolidation at the top here. The one main thing with XLF, guys, is keep an eye on your Thursday low. If we break Thursday's low, it would be a daily downtrend confirmed, and then we would just be looking for weekly consolidation. But the bulls still with a lot of space. They're still in control. I like to see a tightening range at the top end of a move right here. Just really, really good to cool down your higher time frames here on the daily. But if for ever which reason, worst case scenario, we lose this into a daily downtrend, 38 down to 37.5 is your first line of defense right here. Very nice previous resistance, which should be acting as support. And we're just going to be looking, guys, for a weekly higher low, anything above $37, just for a weekly higher low in financials. So if interest rates do continue to tick ever so slightly up to the upside, and it does drag down financials, just know that we do have a healthy amount of space to set a beautiful weekly higher low before some potential further trend continuation here, guys. February and March may be a little bit rocky, but as we get closer and closer to that first interest rate cut, guys, I do believe that the market breadth should be resuming quite good, and the growth stocks will be back as well. Financials will be back as well. It's just right now, as I've been saying, guys, we're in a very divided market between interest rate sensitive stocks and stocks that are not. So that's why you have a bit of bifurcation in the markets. You know, you may look at your portfolio sometimes if you're exposed to interest rate sensitive stocks and the indexes may be green, but your stocks may be red. And that's been the case now ongoing for the last couple of months. Now moving on to XLV Healthcare. So XLV Healthcare, very, very good indeed, creating a ton of space off these lows. As soon as we get a pullback, so as soon as we lose the hourly trend right here, let's say if we set an hourly downtrend in the next few days, worst case scenario, well, we'll just be looking for a daily higher low at this point, anything above 137.24, just looking for a daily higher low. Keep an eye here, guys, 140 area, right? 140.5, 140, very nice previous resistance area, and confluence with your 12 EMA as well. So you can see healthcare has done a great job of protecting this 12 EMA. Did lose it a couple days in a row, but look, lose it in the morning, have it back by the afternoon, lose it on one day, have it back by the next day. So until we get a convincing break of this 12 EMA, healthcare bulls still looking very good. And we are now getting very close to the previous all-time high. 143.46 is going to be the mark to watch. Bulls in full control of this weekly time frame. So really in control of everything, right? Daily uptrend as well is going to be set at this point. So much space off the lows to create the daily higher low for the daily uptrend. And that would just be continuation here of leg number 2 on the weekly. I do believe the momentum is still very, very good for healthcare stocks. You can see daily MACD is also starting to cross back to the upside, and weekly MACD is in full expansion mode as well. So just keep an eye on healthcare. Could be a sector that continues to outperform while the rest of the market lags, and it was indeed one of the only green sectors in the entire market today. Now moving on to your growth stocks, IWM. So obviously on a day where interest rates uptick heavily to the upside, IWM Russell is unfortunately going to get hit to the downside, and that was no different today, down about 1.27%. Your loss leader for the day. Now, unfortunately, daily downtrend is currently set by the bears. So daily downtrend in motion at this point. We're just going to be looking for further weekly consolidation. The line in the sand for me, 187.76. Need to maintain this and hold this in a tightening range if possible. If we lose this, guys, it's going to be weekly downtrend, and that's just going to be monthly further consolidation. But all is not lost. Monthly moving averages are down here at about 186, and this whole range between these two yellow lines is the average of this massive range that we've been in for the past 2 years. We have a lot of long-term moving average support right down here, right? Your 200 weekly is down here at about 183, and like I showed you, your 12 and 26 moving averages are really converging nicely towards the 186, 185 level. So a ton of support for IWM. IWM just not ready yet, guys. What you need to see if you want to see the bulls reverse this, need to put in a bounce, a sizable enough bounce as close as possible to our previous high 199.42 to create the space for a daily uptrend reversal. But since we're currently dealing with upside resistance areas and an unfavorable interest rate environment right now, well, IWM's rally may just be muted until we get some more positive expectations here on rate cuts for the future. So IWM remaining fairly muted, but if it does pull back down here, guys, you know, 185, 184, 183, that's where I will be starting a position. Moving into the Dow Jones down 0.71%, also not reacting too well to your ISM services numbers today, but all in all, fairly decent day by the Dow Jones, right? Any pullback, just still looking for a daily higher low, anything above 37,800, just looking for a daily higher low. 12 EMA guide is going to be the required guide here for your Dow Jones, right? You can see how rarely the Dow Jones has lost this. Only once in January has it lost this since the entire rally in November. So if you want to know when short-term bears are going to be in control and when we're expecting a weekly pullback on the Dow Jones, just keep an eye on your 12 EMA. It's going to be absolutely crucial. As of now, the bulls still in control, healthy daily consolidation at this point. And if for ever which reason we do lose it in the next few days or next few weeks into a daily downtrend, we'll just keep an eye, guys. So much space above your all-time highs right now. Your first area will be this current previous zone of support. However, 37,800-ish is going to be the first line of defense. And then we do have all the way down here. But a lot of space here, guys. Just can't lose this. 37,146 is your weekly higher low at this point. So any daily downtrend, okay, needs to stop before this higher low right here, 37,140, to really keep this weekly trend alive and well. So that's pretty much everything for your indexes. Now let's move into big tech. So big tech, performing mixed today. Apple up nicely, continuing its rise after its earnings drop last week. So Apple still trying to measure the size of this bounce, right? We're still in this. This is such an ugly chart, right? By Apple. It's just all over the place pretty much over the past month, but that's okay. What is it doing? It's just consolidating on the weekly, getting a tightening up of the range and getting a tightening up of your monthly chart as well. So everything looking good. As long as Apple really doesn't flush this 180 level and really start trending lower, it's still looking healthy in my opinion. So now we have a short-term bounce going. We're dealing with this resistance area 190 down to about 187.50. That's going to be the area to watch. If we get above this, it's going to put in a sizable move against this most recent down leg right here, right? So we want to see a decently sized bounce. If we can get as high on this bounce, guys, as the higher end of this range, about 190, that would be over your 618. And when we get over the 618, it gives the bulls the chance to have enough space to reset the daily uptrend here, potentially marking the end of the daily downtrend cycle and potentially marking the weekly higher low for potentially a bit of rally to the upside back towards your all-time highs. But as I was saying after earnings, guys, with Apple's revenue growth, not that much in terms of guidance for the year of 2024. 2024, even for Apple, may just be a transition year where you don't see ridiculous gains on Apple as it somewhat gets left behind and grows into its current valuation. I would not be surprised to see this range tighten up, potentially over the next couple weeks or so. But as usual, if ever for which reason we come down into the lower 180 down to about 175 range on Apple, that is where I'm looking to buy this stock. Everything is looking fairly decent. As I was saying, just a weekly tightening range. Cannot lose these lows. Just need to maintain this tightening range of accumulation at the tops, as Apple has done in the past, where it's risen significantly 5, 6, 7 months in a row, then just takes, about a half a year off, consolidates into its valuation, and then continues to the upside. May just be what's happening to Apple at this point, but I really like this zone, guys, 180 down to 175-ish. It's your previous all-time highs and has been acting as very decent support over the past 6 months. Now moving on to AMD. So AMD down a little bit here today, but after the past 3 days rallies, that's really nothing much of a drop. Even if it is down 2%, guys, AMD still looking fairly decent. What we need to watch out for here is the lower low conversion into a daily downtrend, right? So anything, we're going to be expecting just this line in the sand right here, 162.73. If we break that, guys, it's going to be daily downtrend, and then we're going to be looking, can we hold our previous all-time highs, 164 down to about 168, and do a good job of setting this weekly higher low, right? So that's what we're looking out for. AMD, obviously, I did not like their earnings. They're extremely expensive right now for the earnings that they posted, in my humble opinion, but the daily bounce is looking good. You do love to see when we have such a brutal leg down here that came and flushed our lows, right? So it was daily uptrend, higher low, higher high, and then we went lower low. We were looking for the size of the bounce to give the bulls the best chance at resetting that daily trend. They have bounced over 61.8% at this point, so it could be argued that we are set up fairly healthily for a potential recapture of the daily uptrend and potential just continuation of this weekly move up after 2 weeks of consolidation, after their earnings there. But AMD for me up here, definitely not a buy after their most recent earnings. I have no doubt that this company will perform very well in the long term, but in my opinion, it does need to consolidate. Fairly overbought on the weekly right here, and on the daily it was overbought, not overbought anymore, but just a significant rally without much fundamentals behind it, which is why, I'm a bit wary of the price action of the company right now. I would not be surprised if it pulls back, but if it does pull back, guys, I will be ready. I will be looking to buy this company. I would have to get it anywhere between 140 down to 130. I know it sounds low, but that's just the price that I am willing to pay for AMD currently right now, given their most recent earnings. Now let's move on to Amazon. So Amazon down 0.87%, fairly decent, fairly decent day for Amazon, protecting most of their gains that they had after earnings. That's exactly what you want to see. You wouldn't want to see a company go up 7-8% after earnings and then retrace half of it the next day, right? So it just goes to show that people are still interested in buying Amazon even after their earnings, and currently dealing with our area of resistance. So we were talking about 165 all the way up to about 171, still dealing with that. If we can get through this one, guys, it's now all the way to the all-time highs, 187. Everything looking fairly good on Amazon, right? So they've created a ton of space off the lows after their earnings, ever so slightly overbought on the daily, still extended away from the 12 EMA, right? Just going to be looking as if we continue consolidation, anything above 155, guys, pretty much looking for a daily higher low for further trend continuation. Amazon, one of my favorite stocks for all of 2024, return to profitability, decent cash flow, decent net margins now at this point, and I do expect that to continue. So weekly looking very good as well. If for whatever reason we lose this and set a daily downtrend, potentially filling some of this earnings gap, that's fine. There's so much space, guys. Anything above 145, just looking for a weekly higher low. But I do believe personally that Amazon is poised to continue on its march higher here. Potentially next resistance area is 175, and then it's going to be our all-time high of 187. So Amazon looking fairly good. I'd just be looking for a little bit more of a dip personally to average in or potentially create a new position on Amazon for some short puts, looking potentially below the 160 range. Now, moving on to Google, guys. So Google performing fairly well on the day, 1% to the upside across this sea of red. Google was a positive light in the markets here. So still trying to protect the potential of a daily downtrend. That's what we're looking out for. With the size of this move, we were always expecting a lower high, but we needed to see the size of the bounce. So as of now, the hourly bulls are still in control. You can see recap for the hourly uptrend, need to break today's high to continue this hourly uptrend into tomorrow. If your daily bounce continues, guys, need to see the bulls get as high as this to prove that they can reset to the daily uptrend, right? So need to see the bulls get as high as about 148.72. Let's call it 149. Get me up to 149, and then we can potentially have a new daily uptrend, higher low, higher high pattern formation, because it'll create enough space. But as of now, the bears have engulfed the move, right? So your lower low is right here at about 140.61, and we lost that on Friday. So loss of the daily uptrend. So now the bulls need to reset it either with a V shape, which would be fairly unlikely after that much of a drop, or we need to two-step this. I do think that the two-step is the most likely scenario. On the weekly, Google's still looking very good, which is why I do think that the bulls will be able to recapture this daily uptrend because they control the weekly and they control the monthly as well, right? So weekly looking very good. Weekly uptrend continues at this point. We did not break the low of 137, currently setting the higher low and trying to at least rise right now. So we're going to keep an eye on Google, but Google, one thing's for sure, I do love it between 141 and 138. I do believe it's a very solid area of support. So the whole time that we maintain this range right here in the lower 140s, whenever it comes down, I will be playing Google 141 and 148 because I do think, guys, that 2024 will be a very good year for Google as a whole if they can continue to rein in on costs, of course. But even if they don't, they're trading at a relatively cheap valuation right now. And that's why I like the company moving forward. It's one of your tech stocks, guys, that is trading at the cheapest relative valuation in terms of trailing 12 months, but also in terms of the forward 12 months. So just keep that in mind. Now moving on to Meta. So Meta down about 3.28%, pulling back after their monster 20% rally after earnings last week. So we'll see what happens with Meta, but definitely looking like it does want to cool off a bit. You can see a loss of the hourly timeframes. So if we do continue this consolidation, guys, obviously it's very healthy. Anything above 388.62 is just looking for a daily higher low, but you don't want to see it pull back too much. If it pulls back too much, you could just end up with a tightening range as traders just digest this most recent earnings move here. So for the move to remain healthy for a potential higher low and continuation to the upside, guys, you need to see it remain under the 38.2 fib. So that would pretty much, you need to see it remain above, above about 448. So if we can really maintain above 448 before recapturing the hourly uptrend to the upside and sending another daily candle to the upside like this, well, most likely your daily uptrend will continue. Anything under that, and it really opens the door for a bit more extended consolidation here. But either or is a very good case for Meta. Meta obviously well past the previous all-time highs at this point, which was really below 400. Just now looking for a little bit of consolidation. Meta extremely overbought on the weekly. Just keep that in mind. As I was showcasing in the last couple of times, Meta on the weekly, guys, it's pretty much at its highest weekly overbought level on the RSI in the company's history. And even on the daily, guys, to get up to about 87 on the daily, it's only happened a couple times in the past. Most recently, guys, was pretty much in 2023. After they started coming back from their really big sell-off, right? And you can see that this was another day where they went up about 22% on earnings, then just kind of consolidated sideways for a considerable amount of time before being able to reset the daily uptrend and gaining the level. So it may just be a little bit of time for Meta to consolidate right now, but obviously their earnings were fantastic. Nothing wrong with the company, may just be due for some consolidation. Now moving on to Microsoft. Microsoft looking fairly decent here on the day, right? So 1.35% to the downside, but really in the middle of Friday's candle. So nothing bad there whatsoever. So Microsoft still in full control of this daily uptrend right now. Just a little bit of consolidation at the top. Need to watch out though. Line in the sand, 397.34. If we lose this to the downside, it's going to be daily downtrend confirmed, and then your weekly consolidation is underway. I would not be surprised because Microsoft hasn't consolidated in the last 4 weeks, and you can see, guys, that Microsoft usually, that's how much they run for before consolidation, right? You can see right here, 4 weeks consolidation, 4 weeks consolidation, 5 weeks consolidation, right? So that's usually how much Microsoft runs before it goes under weekly consolidation. So if we do lose this daily uptrend right here and set a daily downtrend for the bears, that's okay. Just looking for weekly consolidation, anything above 366.54, just for weekly higher low for further trend continuation. I would be targeting at this point, guys, your previous 52-week highs, 384.62, which has a confluence right now with your 12 EMA, 386. If we can get back down there, I most likely will be playing some puts, some short puts on Microsoft here to potentially average in to some positions or just make a little bit of a swing trade, but all in all, looking very healthy. Now moving on to Netflix. So Netflix still consolidating sideways after their earnings move, but any sideways consolidation at the top end of the move is great for cooling down your short-term RSI. So Netflix looking very healthy, guys, still in a massive daily uptrend, right? We're just looking for a daily higher low. This is a daily bull flag right now, right? Consolidation, not even giving back like 5% of its after earnings rally. So looking very, very healthy on Netflix. As I was saying, Netflix is just being challenged right now with its 2020-2021 range, which was roughly between 575 and the 500 area. It's still struggling with the top end of that range right now. So just looking for a little bit of daily consolidation here, guys. Even if we do get a slight daily downtrend, as long as we protect a large part of this move, like I was saying on Meta, right, need to stay above the 0.382. So if we can stay above 540 the entire time that this goes under daily consolidation, well, that just means, guys, that we're looking out for the weekly higher low, right? And that's what Netflix is looking out for. Beautiful weekly uptrend, looking for the weekly higher low right now for further trend expansion. Netflix's business is looking very, very healthy right now. Just the chart consolidating a little bit after earnings, similar to exactly what we just looked at for Meta as well. So no red flags on the business whatsoever. If Netflix does dip down here below potentially, 550, 540, I'll be looking to play potentially the 530, 525 short puts for a potential swing trade back towards these 575 highs. And if we crack these 575 highs right away, guys, well, we are moving in to very, very high territory, 612, and then it's your all-time highs, 687. So keep an eye for the break of this range. That would be significant. If we break this right away to the upside, we have enough space to sit on it, use that as support, potentially rally towards our all-time highs later in 2024. Now moving on to NVIDIA, NVIDIA, guys, just continues, guys. Why does NVIDIA keep going up when interest rate news comes out that is bad? Very easy, guys. EPS expansion, heavy revenue expansion. And if I show you what they have on their balance sheet, you'll see that they are just not sensitive to interest rates at all. High free cash flow, high cash and cash equivalents. Take a look at the most recent quarter that was reported, right? Take a look at the amount of debt, $11 billion. How much free cash flow did they generate in one quarter? $7 billion. So literally in the past 2 quarters, they've generated more free cash flow than they have total debt. And they already had about $5.5 billion of cash equivalents on their balance side. So, company is cash rich right now, has no pressure from interest rates whatsoever. And its largest customers right now is big tech, and they will just they won't stop spending money to build their large language models. So NVIDIA stock just keeps going up. There's just too much demand for what NVIDIA is doing right now, right? So daily uptrend is currently still in motion. Your upside resistance target now pretty much becomes 700 psychological, looking very, very aggressive right now. Daily overbought, maintain daily overbought, weekly overbought. So everything is overbought, guys, but I would still not short this thing. You can only really short this if they show the daily downtrend. When they show the daily downtrend, guys, as soon as you see the daily downtrend, weekly consolidation is underway, and then it's very easy, right? As soon as they set the daily downtrend like this and they flush, well, then you enter the trade here, your stop loss goes here, and that's either, right, the top of the weekly for consolidation, or you're wrong and it just continues, but it's a high probability short. If you just try to short this coming up, it's the same thing as buying the dip on a falling knife. It's just the opposite, right? So we need to wait for confirmation, and now is just not the time. So daily uptrend is confirmed. Any pullback, just looking for a daily higher low above 606.51. So we'll measure the size of the pullback for a potential daily downtrend or just some consolidation sideways. But everything looking beautiful on NVIDIA, right? Weekly uptrend as well. Any pullback, just looking for a weekly higher low. So keep an eye on that for NVIDIA. Nothing to say, guys, because there's no real technicals in sight. We're just really waiting for this thing to top out. Now moving on to Tesla. Tesla had a very bad morning this morning in terms of those interest rates coming up, right? So touching 175 ever so slightly before recovering intraday. But as we were saying, guys, the size of this bounce after earnings was insignificant. As I was showing you guys on the fibs, you'll see that it only bounced 38.2%. If you remember this ratio from trades to the upside that we were looking for on both Meta and Netflix, right? You know that if we only get 38.2% of the move back, the likely scenario is continuation in the same direction. So that's exactly what happened for Tesla at this point. Tesla daily downtrend simply just continues, right? So daily downtrend simply continues, still oversold on the stock at this point. Resistance stays put right now. The 180, 168 range is continuously going to be acting as support, So we'll just extend these 2 lines right here so you guys can see. And this also coincides with the downside of your trend line as well. So we're going to be looking at this area to provide a bit more support. But as long as your bears are in control, right? Daily downtrend simply continues. Weekly downswing just continues as well. In order to reverse this, we need to finally see. We only got an hourly trend change after earnings for a couple days. The whole time for the past couple of months has just been hourly downtrend, hourly downtrend, hourly downtrend. So if you want to see the bulls regain a lot of short-term control, need to see an hourly uptrend over a couple few days. Then we'll be looking for the size of the bounce in relation to the most recent lower high, 196.52. Get me as high as possible to there. Then we can talk about the chances of daily trend reversal and potentially reversion of this weekly move as well. But so far, the bears full control. Now moving on to Palantir. So Palantir after earnings now sitting about 1966. So they will have put in enough space similar to Meta and pretty much Netflix at this point after earnings gap up to potentially set the daily higher low whenever we do, consolidate after this move. But current upside resistance will obviously be your 20.3 level, which has acted as resistance in the past, right? So 20.2, 20.3, and then pretty much your 52-week highs all the way almost up at $22. Palantir doing a very good job here. The daily uptrend will most likely be reset in the bull's favor, and this absolutely reverses the weekly timeframes as well. We were looking at this weekly downtrend for continuation maybe after earnings, or the bulls had a great chance of resetting the weekly uptrend. They have just now reset the weekly uptrend, right? Low, higher, low, high, higher low, and now higher high at this point. So weekly uptrend will be reset. Another monthly, we're going to be looking at once again, can Palantir complete the monthly trend breakout? That is what we're going to be looking on at. But so far, so good for Palantir. Just going to be struggling a little bit with this overhead $20 resistance, but now we're well above this most recent area of consolidation. Now moving on to PayPal. PayPal earnings on Wednesday. So price action is going to be fairly muted until then, just perpetuating this tightening range in PayPal for the past couple of days. I'm very happy I called this as soon as we got this nasty move to the downside where the bears pretty much took back a sizable portion of the move, talking about 78%. I said the best best case scenario for the bulls at this point is maintaining a tightening range before earnings, and that's exactly what we do. So in terms of earnings, guys, the expected move for the stock is about 6% up or down, and you can see the upper bound is about 10% away, the lower bound is about 8.36% away. So we'll see, guys. I do expect earnings to either be a complete turnaround story for the stock, as the CEO will focus on improved EPS, improved margins, and free cash flow for the upcoming year with the new measures he wants to implement, or it'll be a disaster in terms of it'll just be more of the same from PayPal. I'm not expecting an actual financial disaster. I'm just saying that if it's more of the same from PayPal, not that much EPS growth, not that much free cash flow growth, even though revenue is expanding, well, traders may just react negatively to it. And everybody who has bought in anticipation of a potential beat on earnings may just liquidate the stock, and we may tend to revisit these $60 to $57 range. Still good value in my opinion, but we really need to wait for earnings for a move on this thing this week. So keep an eye on that for PayPal. Break to the upside would be huge. We'd be breaking this downtrending trend line right here. We'd be closing netly above the moving averages, which we haven't done really in the past 2 years at this point. So keep a very close eye on PayPal after earnings for further continuation to the upside. So that's pretty much everything I had for you guys today. I'll do the portfolio review tomorrow pretty much, because tomorrow we'll have a bit more time after the earnings here. I'm sorry once again for the long video, but I hope you appreciated it, guys. If you did appreciate the video, consider dropping a like down below. It would really help me out. And consider subscribing to the channel if you're new. We'd love to have you here. We do these daily market recaps every single day, Monday to Friday. After the close. So we'd love to have you there for those. And if you have any questions, guys, whatsoever, options, stocks, technical analysis, or macro, or whatever you want, guys, leave it down below in the comments, and I'll get back to you within the next 24 hours. So take care, everyone. See you tomorrow after the close, and peace. Big earnings day tomorrow after the close. Tomorrow we have Enphase, which we'll be looking at. We'll be looking at Chipotle, Elf, Fortinet. So probably going to go over, guys, Chipotle, Elf, and Fortinet. They're my favorite plays. Enphase, you guys know, solar play, still going to be plagued by high interest rates. So I'm not expecting fantastic things from them. So take care and peace.